All right, good afternoon, guys. Welcome to Smarter Options. So today we're just going to start here real quick by going over what are SPY mini and micro futures, which is ES and MES. Okay, we're going to go over a basic intro to futures, how futures traders trade, and then what makes our algo so special. All right. So first, what is an MES ES future? This is pretty simple, guys, but it's just a financial instrument similar to trading a stock, right? You don't need to get too wrapped up on this, but this is actually what it is. It's a contract and a highly standardized financial instrument in which two parties enter into agreement to exchange an underlying security, right? In this case, we're talking about the S&P 500 at a mutually agreed price at a specific time in the future, which is why it's called a futures contract. The longest you can hold MES futures are 3 months, I believe. Okay, so that's pretty simple. It's just a financial instrument, so just understand that. Okay, what are some benefits of futures? Well, one is they're highly liquid. Their market depth gives them, so there's very little slippage, which makes it great for when we're talking about doing automated trading or even just doing regular trading, right? You try and grab so the bid and the ask are always very close together. They trade 23 hours a day, 5 days a week, every day from 5 p.m. Eastern until 6 p.m. Eastern. They take a break. Okay. Otherwise, they start trading Sunday night at 6 p.m. Eastern, and they stop trading Friday evening at 5 p.m. Eastern. All right. There's low commissions. There's no PDT rules, and there's no theta on futures. So these are some things to just know. All right. Point value, minimum price change, tick value, exchange fees, right? So we're just going to be talking about the MES, the micros, and the minis today. We're not going to go over anything full size. Those get expensive. Okay, so for a micro, the MESs, I don't know what all brokers are, but we're going to go over, I'm going to talk about TradeStation right now. Okay, so TradeStation requires you to have a minimum of $1,200 in your account to trade one MES and $12,000 to trade one ES. Okay. Each point value, we're going to call those ticks, is 20.25. So what that means is when you buy these, right? So if it's at, and those numbers are old, this is an old thing I found, but so say like right now it's at 4,200 or 4,300, whatever. Right. So say you want to buy it at 4,300. You can either buy it at 4,300, 4,325, 50, 75, or the next $1 up. Okay. Each one full point, okay, each one full point on the MESs is $5 in your account. So if it goes up 10 points or 10, we'll just say $10, right? But 10 points, if it goes from 4,300 to 4,310, that's $50 in your brokerage account. On the ESs, that'd be $500 on your brokerage account. You think about this, okay? These things can move easily 100, 200 points in a day. Okay, that's where they get dangerous. Okay, so if you get caught on the wrong side, you need to use stop losses. You need to know what you're doing. You can't, if you buy one and you walk away for a minute because you're thinking whatever, and all of a sudden it drops 30 points. Okay, you just lost $1,500 if you were trading ES, and $150 if you were trading a regular MES. So just be aware of that. Okay, exchange fees, TradeStation. This is, like I said, this is some other thing. This is older. So TradeStation for MES, I believe, is 50 cents for a micro and $1.50 for a mini. So ignore those numbers. I'm sorry, should have updated that. But yeah, so that's what you need to know about MES and ESs. Okay, every one full point it goes up is either 500 in ESs, or is $50 in ES in your account, or MES is $5. How to trade futures. So futures traders use supply and demand zones. Supply and demand zones act as support and resistance, but not all support and resistance is supply and demand. Okay. Futures traders trade with a very high risk to reward ratio, or I mean, that's how they trade. They use risk reward ratios. So we're going to go into this real quick. I'll show you a graph here. So here this guy put a resistance below the demand and then a resistance above the supply. I don't necessarily I'm sure that's accurate, but I mean, when things start to consolidate, when things get price range bound, right? that is really when your buyers and your sellers agree on a price. And then you can see at that first demand zone, when it goes rocketing up, okay, so that becomes a demand zone. The theory with supply and demand zones is this is institutional buys and sells. It's not us as retail traders that move that move futures prices. Okay, there's so many being traded, and it's so expensive. It's just not us doing it. So the theory is on that when that demand zone was created, which you can see that large candle out of there, is that there's a bunch of unfilled limit orders in that blue zone. Okay. And then it goes up and then it finds a supply zone. Okay. And same thing. Now that they are estimating that there are unfilled sell orders in that zone. So what futures traders will do is they will put a sell order. So at that top supply zone, right? When it first came down, you would have a buy or a short order at the bottom part of it, and then a stop loss at the top, because if the price gets all the way through that supply zone, it's no longer validated. I mean, the whole theory is that there's unfilled orders there. Okay, and then same thing, you would do at the demand zone at the bottom, at the very top of the demand zone there, you would create a buy order with a stop loss at the bottom of it. And so you can see here how when the price came back up to the supply zone, you would have had a short in place. The stop loss was not hit, and then your profit target would be at the bottom, which would be a buy at the demand zone, right? And then you could have actually switched positions and gone long and cut it on both sides. You could have won twice that trade. Now, say those supply and demand zones, say they're 10 points thick, okay? And let's just say that there is a 50-point range between them. So what futures traders are doing is they're risking 10 to get 50. So they have a 1-to-5 risk to reward ratio. With that kind of thinking, right, they can be wrong several times, and as long as they're right, every 3 times, they're still profitable because they're risking 1 to get 5. So just keep that in mind. All right, now we're going to go into the algo. So I'm going to switch my screens here. Give me 1 second. And we're just going to go talk about this algo I created and why I think it's something special. And we're going to look at the ES chart. Just so you guys know, the MES and ES charts, and I'll show you this, they look exactly the same. That is because they're trading the exact same fund. They're just weighted different. One is just weighted 10 times stronger than the other. Okay, so here we go. All right, so now we are looking at my chart here. So here is the ES chart, which is ES1 exclamation point. That just shows you, this just keeps the continuous most current contract in front. Okay, then here's what this chart looks like, right? We'll just pull up the MES also just so you guys can see it. Okay, exact same chart. Exact same numbers on the side. The reason it's different is just because it's weighted different. If you trade this one, every 1 point it moves would be $5 versus 50. Okay, so we're going to go back to ES just for these purposes. All right, here's what is unique. So what I've done is, and you can see it here, kind of, this shows several trends, but anything that is positive is an uptrend, everything that is negative is a downtrend. Okay, and this shows you the 4-hour, 2-hour, 1 hour, 15, 10, 5, 3, 2, and 1. All my algo is really using is the 10 to 1. I have these other numbers here just for reference. So you can see on the 4-hour chart, this is still trending downwards. But on the 2 and 1 hour chart, it's gone positive, etc., etc. Okay, and like I said, guys, I kind of put in the room, but this video quality may not be good right now because we're live streaming. In about an hour after YouTube has a chance to compile it, it'll get better quality. All right, so here we have a consolidation period, okay, that is formed in this area. Now here, we started to break out, but my algorithm is looking at the 5 different time frames, and what I've done is I found a way to use these different trends and these different time zones to find supply, and what I believe is why it's so special is it's finding supply and demand zones as they're created. So here you can see when you back test on something like this, okay, it's going to show you at the candle after the signal was given, because I have it set to look at, confirmation. So once the 10-minute candle closes, then it has confirmation. So actually in live trading, it would have taken it somewhere in the candle before. Okay, but even right here, this price, as you can see, it hasn't even created a new low yet. But yet my algorithm was able to detect that this was a real supply zone being created and took the play. Here you can see it hit profit targets on its way down. And then same thing. Right here, there is a consolidation zone. And like I said, consolidation is really where buyers and sellers agree on everything. But here's another zone that was created. And the algo, before even creating a new high, realized that this was going to be a real breakout and took its first and took a profit target right there. Now here it did not catch it. This was not a strong enough move for it to catch. So it did not catch that one. It's not going to catch all of them. It's catching high confidence trades. That's how I programmed the algo to work. I wanted minimum loss with the most wins. And I will show you one here where it failed. So here's one. It felt that this was a real breakout right here. Okay. It instantly got denied though. And the bot caught the supply zone also and switched it to a short. So it entered the long at 44.65 and it exited at 40.51. It took a 15-point loss. Okay. But after that, it entered at 44.50. And I have two parts on here. There's a quick short and then a regular short. It went in, it got the signal again, and it started taking profits and it won quite well. Okay, so even though it lost 15 points here, the trade right after at 44.50, and it took trims at 4,400, 43.83. It caught a lot more on the way down, even though it didn't catch it right here. Yeah. So this is the algorithm, guys. This is, like I said, you look at this, it looks for consolidation, and then it finds real zones as they're created. And sometimes those zones, the signals I have it set to receive, are getting it before. I mean, this one happened on a Friday, February 11th that would have been 10:40 in the morning Central. Okay. And the real fall didn't happen until 12:20, which would have been 1:20 Central. Okay. So, I mean, it was a good hour and 40 minutes ahead of the fall. All right. But this is the algorithm. Okay. If we go into its settings, you can back test this. So say you had a $30,000 account trading one order. It says one, but sometimes it'll take two because I have long swings and quick swings enabled. I set it up so my longer swings are catching more definite moves. In the last 2 months on back testing, it would have taken 19 what I would call regular swings, and it took 29 quick swings. Okay, this quick swings, it grabs about 50 points, and on the long swings, it grabs about 120 points. Okay, so you can see here, I have a max stop loss from entry set at 60. Long price targets 120 points. These are full points. And then quantity to exit is on PT1. I have it set at all for the back test. This is quick profit targets. I turned off these. I just put these numbers really high because on the algo, it lets you do a quick trailing, but so far I haven't been able to set that up for a bot to take those trades. So I just have them set to 200 so it doesn't use them. Max loss in the quick trades I have set at 40 with profit targets of 50, same thing, right? So we click OK, we hit strategy tester, we go to the back test, and here is the back test over the last 2 months from January 1st. Taking 48 total trades, 5.5 profit factor, 70% were profitable. Average trade was $1,882. Average bars was 97, so 10-minute bars times 97. So, roughly like 12 hours probably. Or maybe 13, 14 hours, whatever that is. But anyway, you can see here, if we can put on the buy and hold equity. We started with a $30,000 account. Maybe did have one dip here, but overall, it's had a very successful 2 months with a net profit of $90,000. You can go into performance summary and you can see, gross profit. Gross profit's 110,000. It's had 20,000 in losers. Max drawdown at one point was $8,500. Max contracts held. It was 4 at one point as it got bigger. Percent profitable 70%. Average trade. So the average trade is over all the trades. The actual average winning trade is $3,200. The average losing trade is $1,400, which would be that max stop loss I had. Largest winning trade was $6,000. Largest losing trade was $3,500. You can also go to list the individual trades, and you can see the exact time and entries and prices, exits, max drawdowns of each trade, max run up during the trade. So there's some times where it took a loss, but it was profitable at one point. Okay. If you guys would like access to this algo, I'm more than happy to share it. I did fill up with, we have enough live testers for this week. As long as everything goes this week, I'd be willing to add more next week, but I did get a flux people reach out already that wanted to help live test. So I've gotten them going and setting up today. But yeah, guys, so I started live testing last week. It's going well. I went small to start with. I've got it ramping up to go bigger starting next week. So that's the algo though. That's futures, and I think I've covered everything I wanted to cover. So if you guys have any questions, feel free to shoot me a message in my DMs. I'd be happy to answer them. And I'll see you guys tomorrow during trading. Good luck, guys.